Good afternoon, friends, and welcome. I'll be sharing live trades and results with you. We'll be evaluating how well these trades work out. We'll be benchmarking this against the S&P 500. I'm expecting to be outperforming it every month. Along the way, I'll also be sharing some lessons I've learned about investments, trading, and building wealth. And of course, the mandatory disclaimer. This is for educational and entertainment purposes only. It should not be interpreted as advice. And with that, let's get into it. Well, this was a very interesting trade that lasted a lot longer than they usually do. As you know, sometimes Adam trades almost every day, but this one's a little different. And because there's only one trade here, I thought I would also summarize something interesting later in the video. This trade entered in on April 1st. Kind of ironic, but it went in on April Fool's Day. And it lasted an incredibly long time while the market was running. We finally exited here on May 20th. From that period of time, so that's it's a month and a half or more. But when we first went into the trade, everything looked pretty typical. We got a little bit of movement up, but the market gapped up and just kept running over here. That was amazing in itself. Went sideways for a little bit. Adam decided to stay in. We weren't playing around in and outs too much here. The market ran a little bit more. It came down a little bit, bounced, and that's where Adam said, let's go ahead and take our exit at this point. And this was a long running trade. So during this time when we're normally trading, what do we do? Well, right about here, we were sitting in the Houstonian hotel, kind of just waiting for things to happen because there was no trading happening here. Right around this area, when it continued to run, we started to look at new cars. So here's a Ford GT that was available at the dealership. These go for just under $1 million. I thought that might be interesting. Or maybe look at some of these classic cars that I'm also have an interest in. But all kidding aside, on the 20th of April, this trade ended. And we're going to go take a look and see how we're doing this year so far. All right, here we are in our infamous tracking sheet. By the way, I think it's a great idea to be tracking all these trades so that they're very clear to me how they're actually performing. So in the prior section, I said it ended in April, but it was May 20th where that trade closed. On that day, the S&P was trading at 741, pretty good. It had made a run of 13.37%. So 20 days plus another, this was just a long running trade. It did a really nice run. That brings the year-to-date return on the S&P up to 9%. So that is its highest peak. As you can see, these green bars indicate the two highest percent returns in this column. So on this day, it hit its highest return. We ended up, we are trading these SSO, which is a 2 times instrument. So we were at 26%, 26.77%, practically 2 times. So the ETF did its job. That brings our year-to-date total up to 34.93%. That's looking just fantastic. When we look over at our metrics, our winning trades are at 55 versus 70. We're still a little behind on winners to losers, but that's all right. Our beat the market factor is exceeding our expectation of 1.5. And just to kind of give you an idea of what some of the metrics I track that I think are important, for just this year, S&P 9 versus our 34, almost 35%. The drawdown on the S&P was -6. Our drawdown was -5.62. So a little better. In terms of the volatility, the reason you're seeing the volatility be so much higher, I think you really have to look at these two numbers together, the drawdown and the volatility. We have a lot better upside volatility than downside. But this just gives you an idea of how much things can change during the course of a year. So we shouldn't get too cocky just because we're up a little bit this year. Things can turn around if the markets go down and we happen to be in. So we have to carefully watch that. We've got our 5-year chart up here. Right now, things are looking pretty good. The return this year looks great. This is our 5 years worth of history. Our compounded annual growth rate sits about 26.86. The S&P, very strong, 15.24 during this 5+ year period that we're measuring. Again, we're taking just a sample of when we started recording these videos. So I don't think anybody should think that the market's always going to return 15 or we're always going to do 26. It's just not the case. Different periods will have different numbers. But our recorded drawdown was -6 compared to 18.26. And again, this is measured at the end of the year. I'm going to say this for full transparency. During the year, at some point, Adam was also down about 18% or so. So we eat all the drawdown that the S&P does, but we do tend to recover quicker, and that's what happened. It was actually in this year here. We did recover a little bit quicker, and at the end of the year, we were in a little better shape than the S&P was. In terms of volatility, volatility is about the same. So what does all that mean? It means that we do see a better return. The volatility is about the same, maybe even a little bit higher than holding the S&P. So we do eat all of the drawdown, but we do recover quicker, and hopefully as we're measuring sort of year to year, we end up doing a little better. So what do all these numbers mean? I'm going to go into a little discussion on how does this affect your actual accounts. All right, let's discuss just briefly, like, what does this mean in the real world? You know, I shared some metrics with you on beat the market factor or growth rate or volatility. Let's just take a look at what happens to an account balance. So let's say there's two options. One is you can buy and hold the S&P, that's this dark blue line, or you can try and come up with some sort of system that hopefully will outperform. And just what do all those numbers mean? I mean, here's what they mean over a period of time. So starting, at the end of 2020, you had $100,000 and you started to make your move. Well, the first move is you start to outperform at this area, and you can see some of these balances, 141 versus 129. Those are both great returns, and that's a pretty good system. You saw in the next year, there was a little bit less drawdown, -6 versus -18. So the S&P is dropping 18% of its value, and we're dropping about 6%. So now this gap starts to increase. And every time we can increase it a little bit more, it just adds up. And over time, this is the value of compounding growth. So, the bottom line is at the end of the day, if you're holding the S&P, $215,000, you've more than doubled your money. That's pretty good. However, if you can do a little bit better every year than the market does, this got to $362,000. You've more than tripled your money in just a matter of, 5 or 6 years here. That's pretty significant. And this is 400,000. What if this was $1 million and you're talking 2 million versus 3, or 10 million, or 100 million where it's 200 versus 300 million? These are huge differences with bigger numbers. And the trick is you've got to start somewhere. And getting the first $100,000 is really hard. Even if you had $1,000, you could start doing this, or $10,000. But once you start getting to the $100,000 or $200,000 realm, this starts, compounding on itself faster than most people can contribute to it. So I just wanted to run through that real world example of, I look at trades and I look at metrics, and to me, I can, in my mind, build this chart. But a lot of times it's hard to visualize because it's difficult. But this is the real world, what happened to the account balance following those two strategies. And I've had lots of conversations with people about, well, you can't beat the market. You can't beat the market over long periods of time. And honestly, that might be true. I don't know how long this is going to work. But while it is, I'm going to measure it carefully. And when it doesn't work, I'm going to stop. But while it does, I'm going to take advantage because my $100,000 went from 215 to $362,000. That's a big deal, I think. It's not quite double. If it got to 430, that'd have been interesting, but it didn't get quite that high. But I think it's worth considering. And now you can sort of see, like, what do those growth rates mean to my account balance? Because that's really what I care about. But with those account balances, um, I think that's the bottom line. What does it do? So hopefully this has helped. And boy, I'm kind of curious to see what happened, because after that big long trade, we were out a day. I was hoping the market would fall over, but that didn't happen. And we're back in. So if the market drops, all that big gain will go away. But hopefully we'll see how it goes next time. That's it for today. How do you think we're doing? Please comment below and let me know how this compares to other investments you've seen. This is for entertainment and educational purposes only and should not be taken or interpreted as advice. Until next time.